In this, our penultimate presentation on stocks, that's a fancy word for second to last, let's take a look at the types of common stocks, just broad categories. And what we're going to find is that some companies fit neatly into one or two, maybe three categories, and some don't fit in any category because there are thousands of stocks and only a few categories. But these categories are generally well received in the industry and paraphrased mostly from Peter Lynch's book, One Up on Wall Street. And I've added a couple of things and moved things around a little bit. So you're going to steal from the best. One of the common misconceptions that people have is that all stocks are the same. Oh, first of all, we hate the word stocks, right? We like the word businesses. And so obviously, some businesses are very, very different than others. And so let's take a look at the different categories. The first category on slide 74 are blue chip stocks. Now, these are the biggest of the biggest. They're sometimes called the bluest of the blue. But why blue chip? Well, actually, the phrase comes from the gambling tables over 100 years ago, 150 years ago. The blue chips on the gambling tables were the most expensive chips, and most people didn't own stocks. It was just mostly gentlemen, not even women. Some of them were allowed to, but mostly they weren't the ones who did it. Somebody bought it for them. Yes, gentlemen bought stocks, and gentlemen gambled. It's what a gentleman does. And so the blue chips were the most expensive chips. My understanding is that's not true anymore, but I don't know. So these companies have their roots deep in the economy. High quality stocks, long and stable record of earnings and dividends. And you often hear people say that they're value stocks. Hang on a minute. Value to me is different than what they're talking about here. They attract conservative investors. No, we're not talking about politics, folks. We're talking about people who want to invest in stocks but don't want to lose a whole lot of money. Even though they know, if they go in it with their eyes open, that there's going to be times when even blue chip companies, even the big companies fall, prices fall. And so what are some examples? Exxon and Chevron and the big oil companies, Johnson & Johnson and the big healthcare companies, the big retailers like Home Depot and Walmart and Costco. Right, these are companies that have their roots deep in the economy. So even when there's a recession or other stuff, you know they're going to be around. Now, every once in a while, one of the blue chip companies falls on hard times and disappears. Have you ever heard of Kodak? You've heard the name, right, but many of you have never seen that little yellow box of film that was in every store that you walked into. Oh, think about it, folks. Kodak was the company that invented the digital camera. They invented the technology that put them out of business. Oh, well. The next category here are income stocks. And these are stocks with long and sustained records of paying higher than average dividends. Now, some of them are blue chips, but maybe not, These are companies that are in slow growth industries, mature industries like banks and utilities and railroads. Boring, but they're not going anywhere. And again, you might hear people refer to them as value stocks. Hang on to that. We're going to come back to that in a little bit. And so these are, again, companies that conservative investors are invested in. You're not going to get rich overnight, but unless the world ends, you should do well over the long term. Slide number 75. Now, here come the stars, the growth stocks. They're in the news every day. They're on the cover of Vogue and GQ and Vanity Unfair. They got the beautiful teeth and the gorgeous pecs and the gorgeous hair. Yeah. These are the stocks that experience high rates of growth in operations and earnings. Growth rates of 15 to 20% or higher, which means that investors are willing to bid up the price, and so the PE, the price to earnings ratio, is often very high. In some cases these days, way high. Nosebleed section. These companies usually don't pay a whole lot of dividends. Why? Because they need the money the profits to be reinvested back into the company, or they want to concentrate on the growth. So instead of giving the dividends the earnings, distributing the earnings in the form of dividends, they say, no, we're going to grow the company. Well, 20 years ago, this was Apple and Microsoft, and they kept saying, no, we're still growing, we're still growing. You have $160 billion of cash lying around the house. What are you going to do with it? Well, let's write Word again. Every time they do, they make it worse. No, they started paying dividends. Right? It's time to give back to the shareholders. The stock price should go up, but usually it's going to be very volatile. And let's see some examples here. Intel, Dell, Hewlett Packard. Wait a minute. Are these still the growth stocks of today? Are they the stocks in the news with the gorgeous hair? Right? No. These, that 20 years ago, 30 years ago, they were the big growth stocks. Who are the big growth stocks now? Right, the artificial intelligence companies, the chip makers that are fueling the artificial intelligence. What else? What else is really hot nowadays? The driverless car kind of stuff. Yeah. So that these are the hot growth stocks. And so, what's going to happen when that growth starts to level out? Things can get the price can get hammered. So you just have to be really careful with the growth stocks. You have to realize that they're very volatile. Yeah, of course they are. For those of you who are into math, if you don't know what I'm talking about, just ignore it. They're not the investors who are interested in growth stocks. They're not just looking at the first derivative, how fast the company's growing. They're looking at the second derivative, how fast the growth is growing. And as soon as that growth starts to slow down, even though the company's still growing, the stock often gets hammered. Right. And if you don't know what I just talked about first and second, just ignore me. Right? Slide number 76. Here we go, folks. Growth versus value. And we've danced around this topic, but let's get down to it. The investment world loves to throw around the terms growth and value. But the meanings of the terms are not exact depending on who you talk to. Typically, investors often use growth to designate a high PE stock, while they use value to designate a low PE stock. But that doesn't take into account the future of the company or what you see when you look at that. When you look at the company, when you do research, a high PE stock might be a great value, while a low PE stock might not be a good value. So you see, I'm using the term value the way most people use it. They see something there that's worthwhile, that attracts their attention, that encourages them to look further. It might be a high growth stock company with a high PE. It might not be. In January of 2005, Google was selling for around $200 with a sky-high PE, while the old GM was selling for $34 with a very low PE and a huge dividend. And I was looking at this saying, wow, that's a great dividend, but I don't think this is a good stock to invest in. Why? Because at the time, they were not making any money off of their small cars. They were only making money off the SUVs, the pickup trucks, and the very expensive cars. And I just said, next time there's a recession, they're just going to get hammered. And at the same time, about a year later after that, they started floating. You heard the word bankruptcy in GM. And the guy at the time, I forget his name, Bob something. He said, no, stop all this talk about bankruptcy in GM. And sure enough, when the recession rolled around in 2008, GM went through bankruptcy. So did Chrysler, but not Ford. Ford did everything they could to not go through bankruptcy and accept the guaranteed loans that the government was giving them. It was a brilliant move on Ford's part. Well, what happened? Fast forward a few years, Google sells for over $6,000. That's how much it's gone up. Much lower PE. And the old GM stock, which was first renamed Liquidation Motors, and they got really upset. They said, can you just change? That's not a good name. And they said, okay, we'll call it Motors Liquidation, which doesn't make any sense. Well, that stock sold for 4 cents in March of 2011. And of course, it's now worthless. If you have any of that stock, it's not worth anything. The new GM is a whole different company. So, which one was the better value? Was Google with the high PE a value stock in that case? In my humble opinion, it was. It was attractive. GM with the low PE, paying generous dividends, was not a good value. It was not attractive. They were not. They had to change their whole. They did. They turned it around. I think they've done a pretty good job of turning things around. I'm not a big. I don't really know too much about the automotive industry. I don't really like cars, so I basically don't follow them well. But it looks like they wanted to go electric. They talked about going electric. And at the same time, the Chinese were saying, no, no, no. Well, the Chinese government told, they're in charge. They told their manufacturers, you're going electric. And now the Chinese electric cars are selling like crazy all over the world, except for the United States. So people who don't leave the United States don't know. You go down to Mexico and you see tons of the Japanese cars, BYD, Chery, JAC, or is it GAC, one of the two. Yeah, they're selling like crazy. Okay, so which one's a better value? So watch that. Watch that when we talk about growth versus value. Okay, now this category is speculative stocks. These are stocks, companies with a very high degree of risk. Typically, they're losing money or they have no earnings whatsoever. They're a startup. They offer the possibility of substantial capital gains and, more likely, substantial capital losses. And in the past, examples of these were biotechnology, internet, alternative fuels. Now, a lot of the startups that are getting into AI and driverless cars, and these, yes, it's a binary operation. It's either going to be really good or it's going to fall. And I remember this was when Tesla was getting the Model 3, ramping up the Model 3, and people were saying, you guys are crazy. Stick with your Model S and your Model X. You know, they're high volume. I mean, they're high margin, low volume, luxury vehicles. But Musk he wanted a lower price car. And some of the students said, what do you think? I said, well, it's either going to be a phenomenal success or they're going to go through bankruptcy. It's that simple. And sure enough, we've heard after the fact that during the ramp up to the production of the Model 3, they were 3 weeks away from bankruptcy. Can you imagine the stress? That's why the guy's crazy. All the stress he's been through with all his companies, he's nuts. He's going crazy. Yeah, how many children does he want? 17 or whatever. Hey, so anyone want to buy the Robinhood, the AMC, or the GameStop? Are they even still the meme stocks they were talking about? But before you do, and you're looking at a stock that's having a meteoric rise, go back and look at GoBroke. I'm sorry, what was it? GoPro. One of my students was really hot on GoPro, and the stock was doing great. And he was asking me about it, and I said, well, it's a cool product. I know people who love them, who into sports, and they have them on their helmet, or they go diving or whatever with them. But is there really that big a market? Because really, all it is a camera, right? I mean, really, when you get down to it. Now, it's a specialized camera in that you can take it underwater or jump out of a plane with it. I said, well, if there's such a big a market, why isn't Canon or Nikon or Apple and Samsung getting involved? And sure enough, right, after everybody who was going to buy a GoPro bought a GoPro, the company basically collapsed. So this gives us another example, another opportunity to trot out the definition of investments by good old Ben Graham. An investment operation is one in which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So it's an either or, right? You're either going to do really, really well, or you're not going to do really, really well. And so we'll take a look at some examples of these. And remember, when we hear the word or see the word speculation, gambling, it's gambling. And that doesn't mean you shouldn't invest in these folks. I don't, but that doesn't mean you shouldn't. I did a few times back in the late 90s, and they all did really well until they didn't do really well. So I said, I called it my Vegas fund, my Las Vegas fund, my Vegas fund. And it lived down to its name. Now I call it my Benjamin Graham fund. And we don't put stocks like GoPro, GoBroke, and Robinhood, and AMC, and all the AI stocks and all that. We don't do that into our Benjamin Graham fund. Slide number 78. Okay, now, cyclical and defensive stocks. Cyclical. Are these companies that are round? No. It has nothing to do with the company itself. It has to do with the fact that these companies follow the general state of the economy. They follow the business cycle of advances and declines. So their earnings, their overall market performance are closely linked to what's going on in the economy. And any company that makes stuff, materials, is typically very, very cyclical. The poster child for cyclical companies are cars. When the economy is doing really well, people are getting raises, getting new jobs, and their standard of living is getting bigger. What do? They run out and buy a new car. How's the old car? No, I don't want to. I like the new car smell. It's good for your lungs and liver and brain. No. And so you see it. You see it. When you see the economy doing really well, you see the car companies doing really well. The flip side, what happens when there's a recession, right? All of a sudden, my old car is just fine. I don't need a new car. And so these cyclical companies get really hammered when the economy falters, when there's a recession. And as I said, watch the car companies, because they're the real poster child for cyclical companies. But now some of the technology companies, some because everybody has chips in their items, right? And so when they're selling less stuff, there's less chips to be sold. But don't forget that AI is booming for NVIDIA, but that's not the only type of chip out there. And then the next category are defensive stocks. Now we're not talking about defense companies like Lockheed Martin or the companies that sell bullets. Who's else? Raytheon, right? No, we're talking about companies that tend to hold their own or even do well when the economy starts to falter. Now, these are companies that make products that you have to use no matter what, like food and soap and drugs, right? Do you eat more Cheerios because the economy's doing well? Do you eat less Cheerios? Do you wash yourself more often? If you need insulin, you need insulin. Doesn't matter how the economy's doing. You need your pharmaceuticals. So these are defensive stocks. They tend to do well when other stocks are falling. Why? Because you'll hear the term rotation. You'll hear people say, oh, well, investors, traders, speculators, are rotating out of the growth stocks into the defensive stocks to protect themselves because the economy's faltering. And they'll usually do it at the wrong time, just in time for things to get better. Anyway, so that's defensive stocks. Next three are companies that we don't often see that often. Turnaround stocks. These are companies that have fallen on hard times. And what you have to ask yourself, is there a potential for a rebound? Well, what are some examples? Chrysler. In the early 80s, Chrysler almost disappeared, folks. They were making cars so poorly that my uncle, as he drove off the lot, something went wrong. So it was a really bad sign. That was a long time ago, and he cursed that car for years. And then a gentleman by the name of Lee Iacocca stepped up to take over Chrysler. He was the guy who in the 1960s was the project manager for the Ford Mustang, a car that's been in production for 60 years. Yeah. So he was a pretty sharp guy. And he turned around Chrysler. Stock went from in the upper 40s down to under 3, and then back up to the 40s. What you have to do is you have to ask yourself, is there potential for a rebound? And the answer usually is no. That's why I like to call them goners, because usually they don't come back. AMC with the chain of movie theaters, GameStop, poor GameStop, and some others. And the Ford, GM, and Chrysler in 2008 and 9 were turnaround stocks, and thank goodness they turned them around. Asset play stocks are companies that are sitting on an asset that could be sold or spun off. J.C. Penney's is a perfect example of this. They're still hurting, folks, but they had a very profitable insurance division that they were hanging on to until they absolutely needed the money, and they sold it in 2015 to keep the company afloat. Now, how much longer are they going to stay in business? I don't know. Supposedly, they're going to turn a lot of them into apartments and condos. Very interesting. Now, there's an example that maybe you'll get interested in. Who owns Frito-Lay? Who owns Frito-Lay? Look it up. Who owns Oxxo in Mexico, the 7-Eleven of Mexico? Yeah, so there are companies that on the surface you think they're a certain company, but underneath there are some assets that, oh my goodness, I didn't know they own that or they have that as part of their operations. So that's an asset play. And then, of course, penny stocks. Butterfly.com, Flim Flam Incorporated. These are companies that just stay away from them, folks. They're usually scams. If you saw The Wolf of Wall Street or Boilerplate, you realize that these companies are not real companies. They're just shams. And there's some examples. And some of my students say, well, what can I play and beat them at their own game? You know, it's 7 cents and watch it go up to 14 cents and sell before they do. Well, you know, there's an old saying, if you don't know who the patsy is at the poker table, you're the patsy. And that's what's going on with these guys. And we'll see some examples online. Check it out. And in the face-to-face class, we showed them to you. Just stay away from the wrong side of the tracks. And these penny stocks are on the bulletin board, the OTC markets, the pink sheets. Yeah, bad news. Bad. Now, what about companies outside the United States? International stocks, foreign stocks. Well, there are some very good stocks outside the United States. The best companies are not always United States companies. But traditionally, it was difficult for you as an investor in the United States to buy these stocks. So what many people on Wall Street did is they would go to Japan. They would go to Europe and buy a ton of Honda or Toyota or the UK company with Unilever. They buy a bunch of these shares, bring them to New York, and then reissue them dollar denominated. And those are called American depository receipts. So you can buy Honda and Toyota on the United States stock market. Now you can also buy it in Japan. But what does that mean? It means you need an international brokerage account, which used to be far and few between, but now most all brokerage firms offer them. This is the company I work for. That was their bread and butter ever since they opened up, because they have many clients in Mexico, and they have an international brokerage account. And what does this mean? You take your dollars, and then you can move the dollars. You can transfer the dollars to yens or pesos or euros, and then buy the shares on the exchange in Honda, in Tokyo, or in Mexico City, or in Frankfurt, or in London. Yeah, most of us don't do this. Some people might. Most of us do what? We buy them through our global and international mutual funds. Remember, global means everyone around the world. International means outside the United States. Why? Because the mutual fund companies just have a whole lot more resources. They have people all around the world, doing this. So it's just, this is typical. But maybe you get interested in it. With American depository receipts, you don't have to worry about it. You also see global depository receipts, and you also sometimes just see depository receipts. Now, if you do move your dollars to a different currency, then you have to think about the currency issues. It's a seesaw relationship. Say you purchased some stock in Mexico. You moved your money into pesos. If the dollar gets stronger, all other things being equal, and they never are, the stock in Mexico is now worth less. Why? Because when you sell those shares, you're going to get pesos, and now it's going to cost more dollars per peso to move your money back in the United States. Conversely, if the dollar gets weaker, all other things being equal, and they never are, your investments outside the United States will be worth more because when you take that stock in Mexico, you sell it, now your pesos can buy more dollars. And some of you've experienced this when you go visit your friends in Mexico or anywhere around the world. When the dollar is strong, it's much easier for you to buy things around the world. If the dollar is weak, you need more dollars. Right, exactly. And the question is, will the dollar be stronger or weaker in the coming years? Well, the dollar's been pretty darn strong for a lot of years, folks. Until now. Until the orange Mussolini decided to disrupt the global markets with his tariffs. And now a lot of people, a lot of companies around the world, a lot of investors around the world are just saying, I don't want dollars anymore. I'm going to move my dollars out of the United States into some other currency. And so far it has not been an avalanche, but we're still in the first innings of these tariffs and kicking people out of the country. It's pretty scary. I'm very frightened, very frightened. But hey, we'll see what happens. I never thought I would live to see the day where people will be talking about how to get your assets, investments out of the United States. And this is something that Russians, very rich Russians do, and rich Chinese are always trying to get their money out of the country, and it's very difficult for them to do it. China, you have currency controls, and they just won't let you. Russia, you have to bribe somebody, and then you can do it until you're not in the good graces of Putin, and then you fall out of a 7-story window. So this is what's happening slowly in the United States. You're hearing rumblings of people just saying, how can they move their assets out of the United States? And believe it or not, I actually just recently was conversing via email with a reporter at Barron's. She likes my book. She likes my my class, and we talked about 6 months or so ago. And last time we talked, I said, I'm really thinking about how can I get some of my assets out of the United States. And she said, are you really? And I said, yeah, and I'm not alone. And we looked. I pointed her to an article in the New York Times, and then some other places where people were talking about this. And she said, oh, I want to. So I have to get back to her. But I'm frightened, folks. What can I say? Cowards run in my family. Now I digress. My apologies. Let's continue. Slide 81. Now, our last statistic, our last calculation that we're going to do on the worksheets is market capitalization, which is a fancy term for how big is the company. And we've made mention of these guys, the Papa Bears, the Mama Bears, and the Baby Bears. Capitalization. It's a very simple calculation, but we're only going to do it a couple times, and then you're just going to look it up on the internet. The current price of the stock times the number of shares outstanding. See, as we said, the stock price alone is not important, folks. What is important is how much the company is worth. And large cap companies are typically considered 10 billion and up. Well, now you're hearing people say, no, it's got to be at least 15 billion or 20 billion for it to be a large cap company. I don't know. I'll stick with the old one for now. But you could change your mind. It's up to you. These numbers are squishy. They're fungible or they're very fuzzy depending on how you think about them. I still think any company that's worth $10 billion is still a pretty darn big company. And there's a subcategory of large cap called mega cap. You'll hear about these mega cap companies, and there are more and more of them. These are companies that are worth over $100 billion. The Apples, the Walmarts. Now we're getting into trillions of dollars. Apple, who else? Microsoft, Nvidia. For a while there, Tesla was worth over $1 trillion. So there's going to be more and more of these $1 trillion companies. Now that's, we can't even imagine, folks. We just can't imagine how much money that is. That's larger than the gross domestic product of many countries around the world. Yeah. Okay. So remember the large cap. The mid cap, oh, by the way, the large cap are the Papa Bears, right? If you like Goldilocks. The mid cap are 2 to 10 billion. Now you're hearing people say at least 5, 6 billion to be a mid cap, up to 15 or more to be a mid cap. You use whatever one you want, but don't get outrageously off the wall. wall. Don't say a mid cap is $30 billion. No, that's just not right. I mean, someday it probably will be, but not now. And then the small caps are anything below 2 billion, although you're hearing people and you're actually seeing mutual funds that are small cap mutual funds saying, and we accept companies up to $5 billion. So you decide, 5 billion or so. But there's another subcategory under small cap called micro cap. And these are companies that are tiny by publicly traded company standards. I mean, $100 million is a lot of money, right? To you and me it is. But no, in the world of publicly traded companies, that's a micro cap company. And then we shouldn't even discuss this in public company and pleasant company and micro cap. I mean, I'm sorry, penny stocks. These are companies. You hear people say anything less than $1 to $5, but again, don't look at the price, look at the valuation. And you see some of these stocks with 7 cents or 8 cents. I mean, you just know it's a scam. Just stay away. And probably there's a few out there that are real companies that have hit on hard times and are trying to come back. But yeah, we call them goners. Okay, so now our last worksheet will be a worksheet that discusses market capitalization. So in the face-to-face class, we would stop and work on it. And you can do that on your own. They're on there with answer keys and commentaries. So here's an example. The stock price is $20. Well, is that a lot of money? We don't know until we know how many shares are outstanding. So let's say there's 5 million shares. So $20 times 5 million is $100 million. And again, that's a lot of money, but not in the world of publicly traded companies. This is a small cap stock. Some people might say it is a micro cap stock, and either one of those is correct. If you said small cap, say micro cap, you're right. Don't say mid cap, don't say large cap, because that's way off the mark, And let's read. The stock price, for the most part, is irrelevant. You must look at the market cap to see what the value of the company is. Remember Warren Buffett's Berkshire Hathaway? Right, exactly. You have to look at the market capitalization. And so now here's a couple of examples. As of the 12th of September, 2025, let's take a look at some mom and pop shops like Walmart, Costco, and Target. And now that we have learned what these statistics mean, what these numerical measures mean, we can make some assumptions about what investors believe are the prospects in the future for the company. So looking at the price alone is, as we said, it's not something you want to do. You just don't want to look at the price. Because looking at the price alone, you might think that Costco is a whole lot bigger than Walmart. And intuitively, you know that that's not the case. They're both very big companies, but no, Costco is not much bigger than Walmart. In fact, it's a lot smaller. Target looks to be the smallest, and it is, but again, we don't know how many shares are outstanding, so we can't really make any kind of decision. But what we can do is look at the earnings per share. And the earnings per share for Walmart, $2.65, $17.65 for Costco, and $8.58. And so dividing the price divided by the earnings, and we're going to do that a couple of times, but again, once we've done it a couple of times, we don't have to do it again. We just look it up. Gives us a PE for Walmart of 39.1, Costco 54.8, and 10.5 for Target. So just knowing this information, what can we say are investors' expectations of the futures for these three companies? Well, they're pretty excited about Walmart, they're very excited about Costco, and they're not too excited at all about Target. Yeah, 10.5 is these days a pretty low PE. And so investors are very sanguine is the word, very happy to think, and they might be right and they might not be right, that both Walmart and Costco will continue to thrive, whereas they're kind of worried about Target. And one of the things that we look at Target is we can see that they haven't even gotten out of the United States yet, whereas Walmart and Costco are expanding all around the world. In fact, Target tried to move into Canada many years ago. Folks, they're based in the Minneapolis-St. Paul area. They're based in the Twin Cities. You would think they'd be able to put themselves into the Canadian culture and business world without too much of a problem. Well, they stunk up the place and had to leave with their tails between their butts. Yeah. So who knows what's going to happen with Target? But investors are excited about Walmart and Costco. Now, what's the book value? Well, again, that's an accounting number. And as we said, the market value is usually much higher than the book value because investors believe the company is worth far more as a going concern, as a bona fide company that's in business to make money. And indeed, Walmart and Costco's book values are far, 1/10, 1/15. But Target, it's only a little bit less than half. Yeah, people are kind of worried about Target's future. Now, dividends per share, 94 cents for Walmart, $5.20 for Costco, and $4.50 for Target. And so the dividend yield, dividing the dividends by the price, for Walmart gives us almost 1%, which is, not as much as a savings account, but that's not bad. Costco, 0.5%, and almost 5% for Target. So if you were a dividend hound, you love dividends, and I love dividends, we would be very interested in looking at the prospects for Target. Because remember, it's not a savings account. It's not a bond. They could stop paying dividends next quarter. They could just say, sorry, we're not going to pay dividends. What do you think would happen to the stock price if they stopped paying dividends? Ooh, it would get cratered. But dividend investors might be interested. And they say, look, Target's not going anywhere. They're not as exciting as they used to be, if they ever really were exciting. But they're paying good dividends. And then the market cap. Yeah, here's where we find that Walmart is twice as large, not quite, but almost twice as large as Costco, whereas Target is much, much smaller. Now, they're all large cap companies, aren't they? I mean, Target's still a large cap company, but these two are mega cap companies. They far exceed that $100 billion threshold. Now, if you want to call it a mega cap, that's fine. If you want to call it a large cap, that's fine. I accept either one. But remember, people are going to refer to these as mega cap companies. And so just so you know. Cool? Okay, now let's take a look at a couple other companies, a few other companies you may have heard of. Right, AT&T, Verizon, and T-Mobile. Again, looking at the price is not what we want to do. We want to look at the other values, especially the market cap, which we get to at the end. Earnings per share, $1.75 for AT&T, $4.30 for Verizon, $10.60 for T-Mobile, but look at the price, it's a lot higher. And so the PE of AT&T is 16.9, Verizon 10.2, 22.8 for T-Mobile. So without knowing anything else, we see that investors are more excited about the prospects for T-Mobile than they are for AT&T, and they're more excited about AT&T than they are for Verizon. In fact, they're not too excited about Verizon's future at all, are they? Yeah. But that doesn't mean it's not a good value, right? We have to do more digging. Just because investors believe that something's going to happen, or they believe that the future's not bright or it is bright, doesn't mean it's going to be. You pays your money and you takes your chances. But, as Benjamin Graham says, we have to do our thorough analysis, which we're going to do in the next chapter. Now, $1.11 for AT&T, $2.76 for Verizon, and $3.52 for T-Mobile. And sure enough, the dividend yields mimic the PEs. We're getting almost 4% from AT&T. We're getting over 6% for Verizon, which is a whole lot more than what they're paying, what their bonds are paying, what they're paying in interest on their bonds. And only 1.5% for T-Mobile. So again, with the dividends, we can see that investors are more excited about the prospects for T-Mobile. They're fairly excited, but that's still a pretty good dividend, 3.8% for AT&T, and they're not too excited for Verizon, And so they say you better pay me a pretty good dividend, because if you don't, I'm not going to take your money. I'm not going to buy your stock. But what happens if they cut that dividend? Right, the dividend investors are going to be aren't upset about that. And so what we have to do is we have to look at the balance sheet and the income statement, which we'll do in a couple of chapters, and see, well, can they continue to pay that can they really continue to pay that dividend? Because remember, dividends don't lie. If they don't have the cash, then they have a problem, right? They can't pay it, or they have to borrow. Sometimes they would borrow to keep the dividend up, which is not sustainable, folks. Not sustainable. Yeah, maybe you can do that for a year or so, but you can't do that forever. And so we're looking at finally the market cap, and we see that the AT&T is actually a little bit bigger than Verizon. Verizon for a while there was bigger than AT&T, but they're both mega cap companies. But look at T-Mobile, which as a company is smaller than AT&T or Verizon, but people believe that's where the growth is. So 211 billion, 185 billion, and 272 billion, all three large cap, mega cap companies. So you see what the numbers are telling you about the prospects for the future for the companies? Now, are they right? Well, we'll find out in 3 to 4 or 5 years, right? It's all about the future. Cool. Okay, now you would do worksheet number 3. Make sure you can do that calculation. And we're ready for our last presentation, where we'll discuss investing strategies, investing styles. And I'm a bit biased, and I'll tell you right off the bat in the presentation about what my favorite investment strategy is. But you have to decide on yours, and it's not an either or situation. You can mix and match them. Thank you again so much for being in our class. We are so very proud of you. Think about how much you've learned. Most people just don't know this. They just hear somebody say something and say, okay, I'll go buy Apple. I had a very good friend. I haven't seen her in years, but she was actually a pretty successful investor. She was an artist and a massage therapist. I think she still is, and she would tell me about the stocks she was buying, and I would say, oh, cool, that's cool. I've never heard of that company. What's the PE? And she looked at me and she goes, PE? What's that? So she didn't know any of this. She didn't do any of the analysis that we're doing. She didn't worry about the numbers at all. And she was actually doing pretty good, because she had a nose for the companies that she thought were going to do well. And good for her. I wish she would take our class. Thank you so much again for being in our class. We're so proud of you. See you in our last presentation when we discuss investment strategies.